Yeah, so now we are live on YouTube also. Thank you so much, Prashant, for joining in. And it's a privilege to have you at Masterstroke.
Thank you, Brijesh, for having me here. It's a real pleasure.
So, Prashant, Masterstroke is a digital platform where we provide sales and branding tools to mutual fund distributors. We currently have 2,000 paid subscribers and we have 10,000 MFDs connected on the platform. And a lot of tools, and we have been hosting such shows, and people have been very welcoming in terms of participating in such events. And I hope that today's webinar will also be very enlightening to our members for sure. So thank you so much, all of you, to join all our members, non-members from across the country. As the numbers are going up, we will start our questions. So Prashant, let me start with my first question. Bearish or bullish in the current day situation?
Cautious in the short term, bullish in the medium to long term.
Isn't this a patent statement by all fund managers at all points of time?
No, I would not say so. I mean, 2000, 2008, we were quite worried. Last year, we were quite optimistic and recorded on seminars like this. So I am driven almost entirely by prevailing valuations.
All right. So, Prashant, many know you as the star fund manager of HDFC Mutual Fund over the last 2 decades. What they don't know is about your early life and your rise to becoming the most preferred fund manager of the country and across the globe. How easy or tough it was, Prashant? And can you tell us something about your early life?
So, Brijesh, I don't think there is anything remarkable about my early life. My father was in government service. I was a typical middle class. I have a typical middle class background. I'm an engineer and an MBA by profession. I joined SBI Mutual Fund way back in 1991. And they assigned me to equities research. I had no idea about equities research, and equities research was not a preferred option those days. That's where the journey started. And I mean, I have not changed my job after 2 years, 93 onwards. I've been managing the same money, and I thought if you have to manage money in a different job, then why not continue to run with the same one? That's how things have over time grown, and I was lucky that the business got transferred to strong hands of HDFC way back 2003. That's what gave us a lot of scale, and of course, the mutual fund industry has grown in this period. I think all of this put together for a long period of time has led to all of this.
Wonderful. So was there any Eureka moment in your early life that now you're a fund manager, or now you can do it, and now you have the capability to do this? As you said that this was not the preferred thing to start with. So when was it then when you realized that, you have a big job and you are actually good to do this?
So as I said, Brijesh, and I'm not trying to underplay this. I mean, way back in early 90s, things were quite different. And as I said, I mean, equities was not a preferred career option. It may sound surprising today. So I have, throughout my life, I have given it my best, whatever I was doing at that point of time, whether it was studies or career. I even managed fixed income for a few years. There was no Eureka movement, but yes, over time, I mean, I've gone through the ups and downs. And so there have been the pleasures and the pain periods that are typical in a career like this.
Wonderful. You have always underplayed, downplayed your achievements, and we all love you for this. So, Prashant, HDFC returns have been above the roof in recent times, but it has come after a long stretch of waiting. And there are MFDs listening to you right now from across the country who love you, who are your fans. And there are also those who are apprehensive of your strategy and style, what would you like to say to them?
So I think it's true, and it's a very fair comment, Brijesh, that you made, that our last year has been very strong, and that strong performance has come after a fair bit of a few years of weak performance. And I mean, I've been through similar periods, though people may not recall. Way back in '99, performance was extremely weak, and we had sold technology. In 2007, it was a terrible year again for us because we have moved out of infra, capex, capital goods, etc. So I've been through this. This was the third or fourth time, but I am happy things have come back. But I must admit, this time the period of underperformance was a bit longer than on earlier occasions. And with the benefit of hindsight, I feel the reason for that was that IBC took much longer to resolve cases than what was written in law. I think it said 1 year, but it took much longer. It took up to 3 years. So that was one. And second is, I think when the asset quality cycle was ending, COVID came precisely at that moment. That again took 1 year, but I think because of my experience of earlier cycles, we stayed put, and it is virtually the same portfolio what has led to the recovery. So I feel relieved having uh, delivered on what the expectations were by and large, and having made up for the underperformance. Because when you underperform, it's a very difficult phase for a portfolio manager, because you have the savings of lakhs of investors. There is intense, debate pressure. So I feel relieved and happy we have finally come out of it, and our positions have been vindicated because the same portfolio has performed and made a piece.
So you continue to remain bullish on PSUs and your preferred sectors, or you wish to have any changes or any change in strategy per se?
So now going forward,
Yes.
I think Prasidesh, I mean, we are a low turnover fund, and our portfolio turnover typically has been meaningfully below peers. And but it does not mean that portfolio stays the same always. And currently, when I think of the markets, I think most sectors are, the valuations are expensive. They are meaningfully higher than long-term averages. And where there is still value are the sectors which are not liked by anyone. Could be, the energy sector, or the some public sector companies, or tobacco. But by and large, I would feel the valuations are, the multiples are higher than what they have been over last year. So one has to moderate one's expectations of returns going forward. Of course, interest rates are extremely low. Cost of capital being what it is, I think it should still be possible for equities to add value over fixed income. And that's why I said I am bullish with equities over long period.
So you see, Prashant, most fund managers and schemes have equity exposure of 95 to 99% at in most of the market conditions. So today markets are very high. Everybody feels that it's a little stressed, expensive. Still, fund managers do not cut their positions. You have the mandate of 65 to 100. So some people say that it's because investors have chosen the asset allocation, so we should remain invested in equity. What's your view on this? So if you think that the markets are expensive in some sectors, why don't you cut exposure in those sectors in your funds? Because you have the mandate of 65 to 100.
Brijesh, this is a very pertinent question, and the way I would answer this is as follows. One Sensex was 100, today it is 60,000 in 42 years. Our fund's own NAV was 10 rupees, it is 1,000 rupees now in 26 or 27 years. And there have been many periods in this journey of 25 to 40 years where markets have been expensive, where they've been cheap. But even if you held on to equities from those high P multiple markets over time, returns have been pretty good. The reason for that is that India is a reasonably fast growing economy. On an average, profit growth here is 12, 14, 16% a year. And what looks expensive today, if you look at 1 year's hence or 2 years hence, the same thing appears to be cheap. So that is point number one. Point number two is it's very hard to time markets in the near term. And that's why I said short term, I don't know. And that's how it is always. That's the nature of the asset class. What is expensive can become more expensive. What is cheap can become cheaper, as happened last year. I think, and investors are not investing all their money in equity funds. They are doing their asset allocation. And every mutual fund represents lakhs of investors. They may have different risk appetites, different time horizons. I think by and large, I feel that on balance, equity funds running by and large invested is the right way to do it, because let's say you come in cash and markets move up another 20%. You feel they are expensive, but that's no guarantee that things they will fall. They may become even more expensive before they come off. And then the damage that you will do to your performance relative to the benchmark, it will be extremely tough to recover from that. And I think at the same time, people like me, we reach out to investors through platforms like these and suggest to them what are the medium long-term outlook for equities, so that if anyone is overexposed to equities, they can take appropriate actions. And let me tell you one or two instances of what happened in 2008 when markets had fallen and they were close to the bottom. The panic is always at a peak close to the bottom. And some funds moved substantially into cash, unfortunately. And then the markets moved up extremely sharply. And the damage, what that did to the relative returns, it would take you 10 years to recover from that. So I think a well-managed mutual fund should avoid taking significant risk of big time underperforming, because to recover from that is extremely. So I would in a way support what the industry is doing, and I myself in equity funds we run more or less fully invested. Though we tell investors like we did in 2000 or 2008 that markets are expensive. As we said last year, markets are cheap. But in the balance advantage funds, where the mandate is to move in or alter allocation to equities, we have done that. Last year, in our balance advantage fund, we took up the equities exposure to all-time high in 27, 28 years to almost 82, 83%. And we have now brought it down in last, I would say, few quarters to just about 60%. But I think doing that in pure equity funds, to my mind, would not be advisable, because the benchmark is does not have any cash flow.
So I will just have one follow-up question on this, and then I will move on to a few other questions. You see, when I see the long-term performance of HDFC, erstwhile HDFC Prudence Fund versus HDFC Equity or Flexi Cap, with a 25 to 30% lower exposure in a balanced fund, the return delivered by HDFC Mutual Fund U is only 2 to 3% CAGR differential over 20 years. So let us say a HDFC Equity has given 20%, a Prudence Fund has given 18%. So, but if you see the risk return ratio with a 25% lower risk on an average, HDFC Prudence, don't you think, has actually outperformed HDFC Equity?
See, the way to look at this is this. You are right in a way, and I think we have maybe added a little more value in Prudence Fund. But think of it this way: over last 28 years, the fixed income portfolio would have turned maybe 9-10% or 8-9%. I think we would have earned a little more because we have taken fairly good duration calls. But let's say it has earned 8% and equity fund has delivered 20%. So the gap is 12%. 12% into 25% is 3% a year. And the difference is 2% a year. So you are almost there, I would say.
So a lot of investors and mutual fund distributors are surprised the way markets have gone up one way after the COVID, 60,000 touching. Nobody expected this. Did you imagine in your wildest dream that this could happen a year back?
See, a year back, we were extremely positive. There is no doubt on that on markets. And I've done various seminars like this and we have written about it. And I think the ultimate proof of that is that the exposure to equities in our balance advantage fund, we took it to all-time high of 83, 84%. And a lot of people criticized us as to this is not right. But it was because market cap to GDP last year had fallen to 46% at its low. And such opportunities come once in 10, 20 years. And if you let go of these opportunities, there is very difficult to make up for that missed opportunity. So we were quite positive on the markets, again driven by values, and that's how we acted. But it would be fair to say that putting a value to the Sensex, I don't think one would have said that it will hit 60,000. So, but let's just recap. Where are we today? Today we are at 100% market cap to GDP based on next year. And at many points of time, Indian markets have traded around 90 odd percent market cap to GDP. So yes, maybe we are 10, 15%, slightly above longer term averages. But what is happening today was not unthinkable, especially because it was very clear immediately after COVID. And this also we have written in our commentaries that while people are focusing on the pain in the economy, they are not focusing enough on the cost of capital.
Correct.
And as a reaction to COVID, world over cost of capital dropped. And when that happens, it is fair to expect over time asset prices to do extremely well. And current multiples, we have to keep in mind the prevailing cost of capital also, not just in India, but across the world.
All right. So, Prashant, ever since I have been into the equity markets or financial markets, I have read one thing. 4 most dangerous words are, it's different this time. And when the markets fall, the fund industry comes out with various statements that in the past we have been cautious about this. We have been telling about this, and this nobody was seeing, we were seeing, and this was supposed to happen. Markets is at 60,000. You also think the markets are a little stretched. So what is different this time and what is not?
See, it's in the nature of markets. If you look at the market P multiples over last 40 years, they have at times in panic times gone down to as low as 11, 12 times. And in good times, they've gone up to 25 times. So I think clearly we are at a good point of time because economic growth is likely to be very strong. Governments are focused on infrastructure. Interest rates have been dropped. Money has been transferred to the poor income households. There could also be a bunching together of demand. Corporate profitability has surprised across sectors. Look at all manufacturing sectors, whether it is paper, cement, metals, chemicals, textiles, sugar. All sectors seem to be doing quite well. So I think even industrial capex should come around fairly quickly. So net, I think the economic conditions are good. Corporate profitability is good. And in such times, for optimism to prevail, for expectations to become rich, I don't think is out of place. What is different this time, I think, is the cost of capital. In the US 10-year at wherever it is, 1.5, 1.6%. I think this is something that we have not experienced before. The big question is that only for how long or how low. I think that is what is different. I must point out that when three things come together, there is, one should be slightly cautious or moderate one's expectations. And these are, valuations which are clearly at the top end. Not, it's not a bubble, I would say, but we are fairly richly valued. Increasing retail interest, uh, 3 or 4 crore demat accounts pre-COVID becoming 7 crore and growing by 1 crore a quarter. And finally, a lot of IPO supply. So I think these are the three things. When they come together, I think it should moderate one's expectations, and that's what I feel. So there are things which are different, and there are things which are not. But see, I think one thing is very clear, that whether we like it or not, the nature of the asset class is such that to forecast short-term returns is extremely difficult. And if you accept that, then I think it becomes a reasonably straightforward asset.
All right. So, Prashant, you said the churn ratio in your funds is quite low. And there is one question with MFDs or PMS managers or investors who typically raise a question against such strategies, that then why should not I own stocks? I will save on the cost, and I can probably take a call when the markets will go down. For example, let us say Fed raises interest rates, or there is a culmination of the three events which you are talking about, and the markets fall. You probably will stay invested 95, 99% of the client's money. So how do you handle this? What is the point at which you will sell or cut down your equity exposure, or it will never happen, no matter even if you personally feel that the markets are expensive?
See, one, you should not judge the outcome of a decision in hindsight, because hindsight is always perfect. But so you should, I think the best way to do it is you should measure the outcome of a decision over long periods of time. And then at least you can say whether the decision was right or wrong. And our funds now have a 25, 27-year track record. And as I said, there have been many occasions in early 2000, the P multiples were similar way to they are today. And the NAV was 1/40th of where it is today. If NAV today is 1,000, then it used to be ballpark 25. We were in a similar situation in 2007. NAVs again, there maybe would have been, I'm just guessing, maybe around 100, 150 times. So see, in a growing economy, please appreciate, while expensive valuations mean that your returns for some time could be a little moderate or markets may correct. But over time, the impact of growth on returns is far, far more than of the valuations, as long as the business or the economy keeps on growing. And let us not forget that the whole markets are not uniformly expensive. Tech was expensive in 2000, but old economy was dirt cheap. In 2007, consumer and pharma was very cheap, automobile was very cheap, and a lot of other sectors were very expensive. So I think by and large, you feel, even in these markets, there are businesses that are reasonably valued, that are attractively valued. But a decent part of the market, I would say, to my mind, does not offer opportunities to make money in terms of multiples going up. Can it lead to moderate returns? Can there be a correction? Yes, by all means. That's the nature of the asset class. But over time, I think, especially given the low cost of capital, I think equity should be able to add value over fixed income, and that's why one continues to remain invested by and large. We have increased cash holdings moderately even in our equity funds. But I think the best way to handle this is by the investors themselves. And because asset allocation is in their control, I don't even know of the various investors who are there, whether their equity allocation is 5% or 2% or 50% or 80%. So one fund moving into cash, I don't think will serve any purpose for this very disparate set of investors who have different asset allocations, different time horizons, different risk appetite. But yes, I think it is a fair expectation on their part from people like me to objectively share our views on the markets. And I must say, I mean, I can say this much that while our performance may have been through ups and downs, but by and large, our views on the markets, by and large, over time, have worked out pretty well. And
Sure.
we were cautious in 2000, 2008, and we were quite optimistic last year. So I think by and large, these things have played out.
So, Prashant, long term is fine, but what about certain mutual fund distributors or investors who have a time horizon of, let's say, 1 year, 2 year, 3 year from now, and they have been invested for the last 2, 3 years? So they have a time horizon of, let's say, 5 years and 7 years, out of which 5 years has gone by. What is one risk going forward you would like to make them cautious about the markets? Will it be the Fed interest rate? We had Sankar Narain 2 months ago, and he said the only thing investors should monitor is Fed interest rate. If they start rising, markets should fall. Is this the same for you, or there's something one, which is the biggest risk for the markets?
See, Brajesh, I mean, the real risks are not known. I mean, that's the honest answer. And
Or
we have experienced that time and again. So, and COVID being so recent, I mean, it tells us clearly that risks are not known. So, what Naren said is clearly on top of everyone's mind, and it's a pretty evident risk, and I would agree to that. At the same time, I would say that risks or issues that are known in advance to the market, I have seen they seldom attach themselves to the market, because markets in a way prepare for them or discount them. And I think Fed is also aware of what impact this could have on economy and markets. I think they will be extra cautious in managing a tightrope between their actions and what are the market expectations. And I'm sure they will over time guide the markets towards what they intend to do. And there should not be a knee jerk reaction, but I would say this much, that interest rates where they are is not a normal situation. And if there are any surprises to that count, I think it could lead to a correction in markets. I must also say two more things. One, interest rates in India have not fallen as much.
Yeah.
Look at 2005, the 10-year yield in India was lower than where we are today.
yes,
But globally, of course, yields have fallen a lot more. So I don't think US interest rates moving up will, it could dislocate capital flows for some time. It could lead to knee-jerk reactions, but I don't think it impacts Indian economy meaningfully per se. The second thing is that we have seen whenever markets fall globally and Indian markets fall in conjunction, these are great entry points. So whether it was 2000, 2008 or tapering, etc. So if such an eventuality happens, I think we should take advantage of that, because the best time to buy Indian equities has been when they have corrected because of developments outside India, because the growth outlook for India is actually quite promising to my.
all right. So another question that comes to my mind is that in India, it's a large economy. We are almost the fifth largest economy in the world. Still, the universe of stock is so little in India, just a few hundred maybe. And every fund manager, every scheme is almost chasing the same stocks, whether it is infra or IT or bank or even some of the sectoral funds or diversified, flexi cap, large cap. The top 10 stock almost remains the same. With such smaller, universe of stock and so much of overlap of stocks between two funds, how should an MFD or investor choose a fund or scheme?
I wish what you are saying was true. I wish every fund stop holding was State Bank and ICICI Bank. especially 1 year back, right? Then our performance would have been a lot better. So I don't think that's the case. See, but yes, what happens is uh, that the index heavyweights, uh, even if your benchmark is Nifty 50 or Nifty 100 or Nifty 200, but the index heavyweights typically are the same. So, by and large, what you are saying in majority of the funds, if you take a cursory look at the top 10 names, you will see a lot of common names there. And I don't think it is true for India. It would be true for probably world over, because mutual funds are driven. I mean, benchmark composition is a very important factor behind portfolio construction. Having said that, I think if you look beyond the top 10, you will find 20, 30, 40% difference in portfolio composition. If you look carefully, even in the top 10 names, you might find the weights are different. And, uh, and that is what leads to some or considerable difference in medium to long term performance. I think India is a market where the choice of companies is actually quite large, and it is growing by the day very rapidly. India offers you every conceivable sector, apart from maybe, you know, the electronics, which we don't have, but consumer, pharmaceuticals, metals, oil and gas, logistics, airlines, mutual funds, banks, I mean, you name it. Almost every consumable sector is listed in India. So I would say what you are saying is yes to some extent, but I see nothing wrong with that. The proof of that is that fund performances do diverge over.
So it is off late, it is difficult to beat index, and there is a lot of underperformance of a lot of funds. Does it ever give you sleepless nights and make you a little apprehension of the situation, and how confident you think the fund industry is, or HDFC or you, to beat index, especially in the flexi cap or the large cap category?
I think beating index is not easy for sure, and uh, because please appreciate, I mean, if the index returns at 12-14% a year, the expenses, which is a hurdle that you cross even to come at par with the index, it adds up to almost 10 to 15% of the total returns. It is
Correct.
not just 1 or 2%, it is 10 to 15% of the. Uh, See, I think the last 3 years were challenging, 2018, 19, and 20. And there was a very simple reason for that. And this slide we have presented in our yearbook also. If you go back and see from 2005 till 2017, the contribution of the five highest contributors to return of Nifty used to be around 40-50%. Contribution of top five stocks is 40-50, but 2018 it was more than 100%. 2019 and 20 it was around 80%. So the markets experienced a very narrow rally driven by a few index heavyweights, and that kind of an environment is extremely challenging for a very broad-based portfolio. I think current year is more balanced in terms of it's a very broad-based market. So I think funds are getting back some alpha. And when I look at our funds, I think we are almost there, even adjusting for the expenses. So I am not saying it is easy, and there are funds which will outperform, there are funds which will not be able to do it. But we should not extrapolate the experience of last 3 years going into the future, because it was a very narrow kind of.
So what do you have to say about the concept of reversion to the mean, with the price multiples being so high now, and every investor in the world, the big investors, always talk about reversion to the mean? So do you feel that in the near term, we should be cautious in terms of the price multiples coming down for some reason and the market taking a more balanced view? For example, from 46% market cap to GDP, we are at 100%. And the long-term averages in almost all all parameters have been beaten at this point of time. So do you think reversion to the mean is a very strong concept?
Yeah, I think it is a very strong concept, and I mean there could be exceptions. I mean, but I think by and large, in my experience, it has a lot of validity. The answer to this would probably also lie. What about reversion to mean of interest rates?
Oh, yes.
So see, that's the key. So you can't look at P multiples in isolation of interest rates. If interest rates are so low today, it will have some impact on valuations. How long, how low interest rates will remain? I don't think anyone has a clear answer. I think the answer to that over time will come from inflation. And to that, I think even central banks would say, I mean, I will observe, see inflation, inflationary trends, inflationary expectations, and we'll act accordingly. I feel, uh, I mean, I do believe that at some point of time, interest rates will go up. This level of low interest rates, to my mind, is not sustainable for very long periods. And to that extent, I think even multiples in many sectors have room to correct. What time, I don't know. In 1995, Lever used to trade at 40-50p. And over the next 10 years, the price remained flat. Earnings kept on growing 10-12% a year. And the PE multiples came down from 40x to 20x. It took 10 years. So these cycles can be very long. Interest rate cycles, economic cycles, business cycles, valuation cycles, they can typically take longer to play out than, I mean, typically what we would expect. So no one asks for, invest in a business with a 3, 5, 10-year view. Some people may hold for 10 years, but I think we tend to measure performance over much shorter. So I think over time, what you are hinting at should happen. But we must again keep in mind, if a business keeps on growing, even if you buy at 30 or 40p, and if the growth is pretty good, over time, returns may still be decent, driven by growth, even if even if multiples correct over time.
Okay. So allow me to say this, Prashant, that you are among the most loved and hated guy at the same time. Does it wear you out? How do you handle this? And how do you get the courage to stay on your course?
So honestly, first time I heard this. So I mean, see, I mean, the market thrives on diversity of opinion. I stop trades because two people think very differently about the stock. People may agree, disagree with my approach to investing, and I do the same with them. But I don't think this should be a cause for either love or for hate. So, but yes, when I honestly do what I think is right, and my interests are fully aligned with that of the funds of the unit holders, and uh, I feel good that I've been able to invest, manage money in these funds uh, according to what I thought was right. And I've seen tough times, but we have come out of it. And but I see no reason why I should be loved or hated just because of a particular style of investing. The world would become extremely boring if everyone followed the same style.
So you never get wear out from this, never get any stress when newspapers or media or investors or associates raise a finger at you in terms of your performance.
See, I don't need the media to tell me my performance. I know it before them that how I am doing. We know it every day. So, and that's why I always tell that you should never put pressure on a portfolio manager. It serves no purpose because as it is, he is under intense pressure. The score is there in front of everyone. But what gives me confidence and to stay the course is the understanding of the businesses that we invest in. And that's why I said at the beginning. So what I am happy about, the same businesses, the same banks that people were putting a target price virtually in 2 digits are now 5x the price, and people are still putting out buy reports. So and it's only 18 months. It is not 5 years. I think we invest in businesses that we understand, that are sustainable, and are growing and are at a reasonable value. And over time, I have seen, if your understanding is correct, if what the price you pay is correct, over time, performance will come. And unlike elections, in stock markets, the majority need not be right.
Correct.
In fact, majority opinion is typically wrong in stock market.
Correct.
In 2000, everyone was positive on technology. And what happened? Next 8 years, what outperformed was world economy, which no one wanted to buy. And we used to get hate mails then also. What you are doing is not correct. And in 2007, you may not recollect, or you may probably recollect as well, uh, consumer companies were the most out of favor. And people used to call them, these are slow growing, boring businesses. And look at what has happened in the next 10 years. 2013-14, pharma was the consensus overweight, and it has been the biggest underperformer. 2016-17, people used to say that Nifty is not a competition for me. I beat it hands down. And look at what happened to next 3 years to Nifty. You said people have struggled to beat Nifty. So I think whatever majority opinion is in equities, it reflects in either overvaluations and undervaluations. And over time, as mean reversion sets in, I think the majority is more often proved wrong than right. And that's how, you manage to add value once in a while. But I also admit that there is no one way of making money in stock market. There are various styles, and one should act according to what one understands and what one feels is the right way out for them.
Fair enough. So, Prashant, what is your opinion about the role and chance and luck in managing funds and investing? Will you agree to observations of writers and economists like Nasib Taleb, who says that randomness plays a big part in our success, failures, and especially in the fund management industry?
No, I fully agree with that. And why just fund management? Chance plays a very big factor in our life itself. Where we are born, to whom we are born, what time, what are the economic conditions, what school you go to, whom do you marry. These are many of these decisions are not in your control, and they have big impacts on your life. So I would say that even in investing, like life, luck or chance plays an important role. But I think it is not in your control. You focus on what is in your control, and what is not in your control, you hope for the best. So there are very bright people, very hardworking people who, because of some unfortunate reasons, are not able to do well, and others who are probably less competent do better. That's part and parcel of life. But I also feel that if you apply yourself seriously to one pursuit, it improves your chances of success, and the role of luck can get reduced that way over time.
Okay. 2 years ago, I got hands into your yearbook, and I read and I saw that the long-term performance of 15 years of large cap, mid cap, and small cap is almost similar. This was the observation of HDFC. In such a situation, and 15 years is quite a long period of time, what is your message to mutual fund distributors in terms of selecting schemes? Many mutual fund distributors, especially smaller towns and who are new distributors or managing lower amount of AUM, are excited about mid caps and small cap because they can give higher return. That is the perception of the market. But your data point suggested otherwise. What's your message?
So I've long struggled against this, and there are certain opinions which people form without checking the data. And before 2000, I think 15, there was not such a big divide between large caps, small caps, and mid caps. And I've been in the industry for 30 years.
30 years.
But I think 2015, 16, 17, small mid caps outperformed massively. And human mind is very simple. It simply extrapolates the past into the future. If 3-year returns are very strong of certain asset class, it leads to higher 10 and 15-year returns also. Now, the observation is same, but one can conclude in two very different ways. One can say, look, the long-term performance of this asset class is superior. Therefore, it is likely to continue to perform in the future as well, because after all, I am looking at 10 and 15-year returns. And the exact opposite conclusion to that could be, look, this is not justified by business performance. And now, since even the long-term returns are out of sync with the business performance, this asset class is overvalued. And that is the second observation is the right observation. So let me explain to you what is our stance on this. And we have been saying this very consistently. See, a business is large or small only because of the nature of industry it operates. If you are making bearings, you are likely to be a mid-cap company. If you are making cars, you are likely to be a large-cap company. But the growth rates of the businesses are not linked in most cases to the size of the business. As you can imagine, bearings and cars will probably grow at similar rates. So I think one should not read too much into this that small mid caps grow faster. There is, in fact, we have given profit data also in the same yearbook. And even the profit data supports that growth rates are virtually the same over across these categories. In fact, the small caps tend to underperform a bit, the large and the mid caps. And the reason for that, again, is very simple. There are two types of small companies. One that are leaders in small businesses, and the other ones which are followers or weak companies in larger businesses. And in tough periods, this weak set of companies in large businesses, they tend to destroy a lot of wealth or capital. And that is why over really long periods, if you see the small cap index as a index, it tends to underperform the mid and large caps. So I would say people should focus more on the asset class. Equities is an asset class that rewards patience, that enables compounding at much higher rates in a tax efficient way. And the differences what small, mid or large companies can create wealth is quite small. But yes, if you want to invest in small caps, mid caps, no harm in that. Maybe you could limit your exposures there to 1/3 to 1/4 of the portfolio. Because in bad times, these businesses, they tend to suffer more, and that's why they are a little more risky than the large.
Fair enough. So last few questions, and I presume, and the world presumes, that Prashant, Jain means equity. You eat, sleep, and drink equity. Is there anything else in your life? And what is your hobby? Would you like to share a bit of your personal life about things that excite you, and what is your life beyond equities?
So, Brajesh, unfortunately, I do have few interests, but apart from limited time that I get with my family and equities, there is very little time. I hope to pursue some of these interests when I, move beyond equities. But thus far, there has been, to be honest, quite little time. But I do sleep quite well. I do meditate a little bit just to maintain balance.
So nice. So if you can share just two learnings or mistakes in your life.
So I have made mistakes of timing on and off. So I have got out of sectors slightly early, but in the long term, those decisions turned out to be right. But I have also got into businesses quite early because I have focused more on value and less on the near-term earnings momentum. And sometimes that business conditions have taken longer to change than what one had anticipated. So I think at times probably I could have managed a risk little better. and I am wiser by that. Learnings, I think, see, people get much less out of equities than what they should, because uh, they try to extract extra returns from equities, and they don't realize the power of compounding. See, 100 Sensex has become 60,000. And in these 40 years, everything that could go wrong has gone wrong at some point or the other.
Yes.
You name it, it has gone wrong. Wars, scandals, high interest rates, low interest rates, Pokhara, nation crisis, 9/11, Lehman, tapering, COVID, everything is happening.
Everything.
But someone who has stayed put, I think he has made more money than 9 out of 10 traders. 9 out of 10. Maybe there is an outlier trader who has been more successful. I think equities are a very simple asset class. Asset allocation is a very powerful tool. And we are fortunate to be in a country which is large, competitive, growing, reasonably well managed, and is improving by the day. So I think we should just understand the see how many funds are there where 10 rupees of NAV has become 1,000 rupees or more, or
That's
maybe
okay.
slightly less. I think, what have we done to, and it's virtually tax free. I think if equities are a very simple asset class, but what is simple is not always easy. Equities reward you for inactivity. They reward you for being patient. And it's a very generous asset class because in every sphere of life, you are rewarded for activity. Work hard, do more. But equities reward you for inactivity. I would say people should focus on getting their asset allocation right, in tolerating near-term volatility, in being patient with equities. And that has worked out extremely well for myself in my individual capacity also. Because virtually my entire savings for a very long period of my career have been invested in equities, and it's gone through ups and downs, but in the end it has worked out extremely well.
Naturally. So there is only one Prashant Jain. But if Prashant Jain were to choose a couple of fund managers whom you adore in India and internationally, who will be there?
Yeah, I think locally, let me not comment because it could lead to some complications for very obvious reasons. But I must say I admired Shiva Subramaniam quite a bit. He's no more. I think he was a very ideal professional in more ways than one. Very committed to his job, long-term oriented, and he just let go one fine day, and he's just reading books and enjoying life.
Fantastic.
It's not easy to do that. So I think he definitely one has very high opinion of. And there are quite a few very good managers in this industry, both in our company and outside. And globally, I think while Warren Buffett, of course, is extremely well known and popular, and I've learned a lot by reading him. I think I really like reading Howard Marks. I think there is one very good book by him, The Most Important Thing.
Yes.
Very
Yes.
small book, but a very good book. And I think so. There are again. The quality of writing outside India is far superior to what people in India have managed to do. We learn a lot from.
Any one or two book you will like to recommend to the audience?
See, one I've already mentioned to you
Yes.
about Marx. I think there is one very good book by Peter Bevelin. All I want to know where I'm going to die, so that I never go there.
Okay.
This is an extremely readable book. People of all ages can read this. It tells you as much about life as it tells you about investing. It is a imaginary conversation between a young man and Charlie Munger and Warren Buffett. I think this is a very enjoyable book. There is another book on market cycles by Howard Marks, which again I thought it was quite good. And one book which I would recommend for everyone to read is The Psychology of Money by
Morgan
I,
Housel.
yes, Morgan Housel. I think that comes extremely close to the way I also relate to money. And I think it's a book extremely readable and I think full of utility and insights.
One advice you will give to mutual fund distributors.
Well, I think they should see it's a very tough job being a mutual fund distributor, and I fully empathize with that because equity, as I said, is a very simple asset class, but not an easy one. If you tell an investor to buy a fund and hold for 10 years, then he feels I can do that on my own. Now, but it is not easy to hold for 10 years because when the headlines are scary, people tend to move out. So I think a mutual fund distributor has a very tough job because uh, he's managing constant mismatch between reality and expectations and through changing times that are good and bad. But still, I would say they should try to educate investors the right way about equities. And whether we like it or not, we are all constrained by our ability to forecast the market's near term. And unfortunately, that is what many clients expect us to do. So that's why the answer lies in educating investors about the long term potential of equities and getting the asset allocation right and being patient with equities because I think the patient investor is rewarded more by equities than the more intelligent investor.
Wonderful. The final question from my side. What is the secret of making money in the stock market? What is your brief answer on this?
I think patience and risk management. So I think, see, you are in an economy where the nominal GDP is growing at 12-14% a year. That is 4 to 8% more than interest rates across cycles. So if you simply sit in that boat, you will earn 4 to 8% higher than interest rates over time and in a more tax efficient. So that is a very simple thing. And even in when capital markets are bad, the economy is still growing. So the value of businesses is growing, the price may not grow. So I think that is point number one. I think risk management to the extent risk management is extremely important. One, you should invest only as much as you can hold in equities. Don't borrow and invest. To my mind, one should not participate in derivatives unless it is for hedging or risk management purposes. One should remain diversified across businesses because individual businesses or sectors could go through considerable change or pain. I think one should remain diversified. And of course, this is my personal style. I mean, I feel that focus on value reduces risk over time as it also gives good return.
So nice. So allow me to take a couple of questions which audience have asked, and you can also pick up a couple of them from the Q&A box. One question is about when our HDFC Tax Saver will start giving decent returns.
So we are working on that. It is work in progress. So we have managed to turn around most of our funds. And this one still, I think, but we are very focused on that. And we always are concerned when any of our funds, even it's a very small fund, does not do well. I assure them that it is getting our due attention, and over time we hope to turn it around.
Kishan Biani is asking, is there more pain left in the current down cycle? Do you see, and let me add a follow-up on this. Do you think this is just a correction or more than a correction? What do you think?
I don't think we will know, to be honest. I don't think we know. And but see, this is a time to moderate expectations, to reduce risk in portfolio. This is not the time to increase risks in portfolios or to have elevated expectations from the market. And but I don't know. I mean, I really don't know. But see, think of it this way. There is a very simple saying that time in the markets is more important than timing the markets. I started my career at 4,000 index. And I have seen this question has been always asked. Ki, I mean, can they go up or can it come down? See, over time, I think these things don't matter. But if you are leveraged, if you are your asset allocation is more than your risk appetite, I don't think it is a good time. You can do that. I mean, even though I don't recommend it, but in deeply undervalued markets. But in these type of markets, I don't think it would be right to.
There's a lot of hype. And the final question from the audience side, I will ask this question. Any observation or would like to answer anything on the cryptos?
To be honest, it is too tough for me. I don't know. I mean, I really don't know. I wish I knew, but I genuinely don't know. But if you don't know, then stay away. I mean, if someone else understands or they are making money, let that. We should not chase returns in something that we don't understand. Because if you make a big loss, it can set you back 10, 15, 20 years, no period of time. So I simply stay away and I don't understand.
Wonderful. Thank you so much, Prashant, for your time. And it was lovely to interact with you. And I hope the audience got a lot of answers to this question. We are live on YouTube and thousands of people will watch this interview in the days to come. And we adore your funds. I personally am a big fan of yours, and we have very high exposure in HDFC. And people have been questioning me also in the last many years that why you as an individual believe into HDFC for so long. And almost 25% of our assets are with HDFC mutual fund. So it was lovely to interact with you on a personal note. Thank you so much for Prashant for being a part of Masterstroke.
Oh, thank you, Brijesh. I thoroughly enjoyed this interview and questioning was outstanding. Thank you so much.
Thank you. Thank you so much, Prashant. Take care. All the best. All right. Thank you so much, friends, for being here. Do let me know about this interview and this webinar. How did you like it? And you can watch this later on also on YouTube. And stay connected with us. We have a lot of webinars and interview coming in the near future. I wish you all the very best. I'm sorry for some of the questions which I have not been able to take. And with that, I will say goodbye to all of you. Have a lovely day.